What follows is an examination of the historical record, the underlying market forces, and ongoing stresses that destine the U.S. economy to experience yet another prolonged period of financial and economic crisis. This one, perhaps, will be the worst ever. The daily news on the state of the U.S. economy is often contradictory. Economists, government spokespersons, the chairman of the Federal Reserve System, and economic commentators each look at trends and statistics and offer differing views of where we are and where we are headed. What we must look at are the cumulative stresses building in key segments of the economy, government, and our society. Armed with these insights, we have a good chance of seeing what the future holds and maybe, just maybe, taking corrective actions. Here is a look at the boom-to-bust nature of the U.S. economic system just since the beginning of the 1970s. Cycles keep repeating despite changes in law, despite changes in public policies and taxation, despite warfare, despite human-caused disasters, and despite disasters defined as natural. Only the depth and duration of the cyclical crashes differs. The current cycle began in 2010. 12 years into the cycle, there is ongoing debate and concern that yet another serious downturn is on the horizon. And the cycles go back several centuries. This chart graphs those cycles that occurred between the 1880s and 1950 as reflected by changes in gross domestic product, GDP, the standard measurement relied on by government analysts and most economists. However, caution is necessary where GDP is relied upon as an indication of a society's well-being. Just because GDP is said to be increasing, this does not mean that all is well. The official definition of GDP provides part of the reason why this is the case. GDP is defined as the value of all goods and services produced within the geographic territory of an economy in a given interval, such as a year. One might ask which of the goods and services produced actually improve our well-being and which do not. Moreover, each and every year, a portion of our physical infrastructure is consumed by depreciation and not replaced. There is the destruction of material goods caused by warfare or natural disasters that stimulates production, but not necessarily full replacement of what was destroyed. Expenditures on the military, on cleanup and rebuilding of what is destroyed by warfare, by hurricanes, by tornadoes, and by other disasters adds to the GDP measurement. However, to quote economist Joseph Stiglitz, GDP is not a good measure of economic performance. It's not a good measure of well-being. The correlation between increases in GDP and improvement in living conditions seems persuasive on the surface, but one must look at what is happening in any society for a clearer picture of reality. A clearer picture of what has occurred during a period of time is, I argue, shown by the change in the depreciated value of the stock of tangible wealth, of actual goods. Consider that when abandoned homes and other buildings are demolished, the cost of this demolition increases GDP even as the tangible capital is decreased. The rubble will be hauled away, burned, buried, or recycled. The lot may remain empty for years or even decades. An alternative measurement, the Genuine Progress Indicator, was developed by Friends of the Earth to include key environmental health factors. The data included within the GPI reveals that the overall well-being of a significant percentage of the U.S. population reached its peak in the 1970s and has been declining ever since. What should interest us is why this is happening and what ought to be done about it. The economics discipline offers a broad spectrum of answers. Each school of economic theorists offers a continually evolving set of arguments supported by historical statistics run through computer models incorporating unique theoretical assertions. And of course, there are purely ideologically based perspectives on what constitutes the appropriate relationships between the individual, private entities, and institutions in government. A current approach to analysis by some economists is what is referred to as real business cycle theory. Economists examine the impact of various systemic, technological, and other shocks that spread throughout a society's economy. The underlying assumption is that except for these shocks, the economy would continue on a sustainable path. To some, the financial and economic crisis of 2008 can be viewed as the consequence of rapidly occurring shocks to the global economic system. To others, the crisis is the predictable outcome of long-existing systemic problems that periodically reach a level of stress that triggers a severe contraction. And to still others, these and other factors are involved, such as the consequences of climate change. Adjusted for inflation, note how frequently the United States economy, as measured by gross domestic product, has sometimes experienced negative growth. The question I ask, as previously noted, is whether there was a net decline in the value of tangible capital goods. By this I mean, did the value of newly constructed capital goods exceed the depreciation in the value of such goods? And, of course, some portion of the stock of capital goods loses its functional utility, is essentially consumed, and is dismantled and scrapped. There occurred an interesting and somewhat unusual recovery in the prices of goods and services within just a few years after the 2008 crisis. Note that by 2010, price deflation ended. For most of the next decade, prices experienced modest annual increases before really climbing in 2020. One part of the reason is that the federal government stepped in with an emergency unemployment compensation program that put hundreds of billions of dollars into the hands of people who lost employment after 2008. The amount was small when compared to what was provided to the financial sector and other corporations, but without it, credit losses, apartment evictions, property foreclosures, homelessness, and personal bankruptcies would have been even worse. As this chart provided by shadowstats.com shows, official unemployment was reported to be 5% at the end of 2007, increasing to a high of 10% in October of 2009. Then stubbornly remaining high until finally falling again to 5% in 2015. That is what appears on the red line. However, when we consider the number of people who are not working but are not counted as unemployed, the percentage may have been double or triple what was publicly reported as the official rate. Add to this the number of people who were and are employed only part-time. As of June 2022, around 25 million people were working part-time. However, the U.S. Department of Labor reported that of this total, only 3.6 million were employed part-time because they were unable to find full-time employment. This was the lowest reported level since August of 2001. One reason given is related to the difficulty of parents with young children finding affordable child care. Increasingly, more adults also choose to work part-time because they are caring for aged parents or disabled family members. Household income has experienced two major shocks during the current economic cycle. Firstly, inflation adjusted, that is real, median household income, shown on the blue line here, did not recover to the 2007 level until 2016. Secondly, the downward slope in 2020 comes with the pandemic, which has brought about a major shock to our economy, to our institutions, and our public service systems. As we remember, credit-fueled and speculation-driven residential property markets came to their inevitable crash in 2008, just as repeatedly occurred in the past. Thus, it is appropriate and necessary to focus attention on the cyclical character of property markets in order to understand the systemic reasons for cycles. Remarkably, new construction did not stop in 2008, and by 2012 was again on an upward climb. Some regional markets experienced significant declines, while others weathered the financial storm reasonably well. As new construction picked up after 2012, 7 of the 10 metropolitan areas with the most housing construction were in the South, 3 of them in Texas. Since then, the nation's property markets have generated a considerable wealth effect for some, while raising the cost of acquiring a residential property for many others. Apartment rents have also climbed to levels that many households cannot afford. The recovery has been credit-fueled and speculation-driven. Owners of residential properties, whether owner-occupants or investors, have experienced huge increases in resale value since 2010. The total value of residential properties, buildings, and land in 2022 is estimated to be $43.4 trillion, according to a Zillow analysis. These values increased by almost 20% during 2021. This increase cannot be accounted for based on the replacement cost of new homes. Most of the increase comes from a calculation of the aggregate resale price of all residential land. Here we see that for those who are owner-occupants, the equity they enjoy in their properties climbed to around $27 trillion in 2021. A softening of some residential property markets in 2022, caused in part by actions taken by the Federal Reserve to raise mortgage interest rates, is slowing the rate of increase. Data published in December by Yardeni Research, Inc. puts equity at $29.6 trillion. At the same time, declines in some markets has taken away a portion of previous increases. Investment in residential property was reignited once the Federal Reserve embarked on its program of monetary expansion, that is, quantitative easing, and the lowering of interest rates. Note here that the volume of purchase money mortgage loans, the orange part of the chart, has remained remarkably steady since 2007. The heaviest volume of loans involved people refinancing out of higher rate terms and after 2008 out of the subprime category of loans, provided they were creditworthy. Refinancings returned hundreds of dollars to the monthly income of some households. Other households extracted value to pay off other debt, pay for a son or daughter's college education, or other purposes. Now, in the current economic cycle, the Federal Reserve has gradually raised interest rates as a strategy to deal with inflation. Refinance volumes jumped in order to close before the rate increases occurred. With each increase in interest rates, the opportunity to lower monthly payments by refinancing falls. We should expect then to see a significant fall in mortgage debt refinances in 2023 unless the Fed concludes the risk of inflation is less than the risk of a deepening recession. The 2008 crisis ushered in real fear of a global financial collapse, and this triggered a rise in gold prices. By the end of the first quarter of 2008, gold passed $1,000 an ounce for the first time ever, then kept climbing. The gold price on the 9th of December was just under $1,800 an ounce, and a Forbes Advisor article dated 17th of August 2022, Wayne Dugan answers the question, is gold an inflation hedge? He wrote, the Consumer Price Index, CPI, a popular measure of U.S. inflation, gained 4.2% year over year in April 2021, its first annualized gain of more than 4% since 2008. Since then, average annual U.S. CPI growth has been around 6.8%. Gold prices have eked out an average annual growth rate of 1% over the same period. The important point to think about is that for the most part, what is bought and sold is gold that has already been mined, refined, and stored somewhere. What is taking place is one party experiencing an increase in gold assets and another party or parties experiencing an increase in financial assets. The seller of gold is not the only party to enjoy income generated by the transaction. The holding of precious metals has historically served as a hedge against economic instability. And of course, since 2021, there has been the enormous shock to the economy caused by the disruption of long-established economic relations and the global exchange of commodities, fossil fuels, and other goods caused by Russia's invasion of the Ukraine. On the positive side, this has resulted in an accelerating commitment to the development of alternative sources of energy and of vehicles powered by electricity, although the current battery technology to power electric vehicles has its own supply and environmental challenges. Extracting oil in some parts of the world has been relatively easy and inexpensive. In other places, the technology required and the cost of extraction and refinement justify production only when prices are sufficiently high. One important element in all of this is political risk, as indicated by this historical chart. Clearly, for a multitude of reasons, our reliance on fossil fuels must be dramatically reduced as quickly as possible. Looking back again at 2008, the global demand for crude oil fell, even as crude oil production modestly increased. Output in 2009 was around 74 million barrels per day, and despite the price volatility, climbed to around 83 million barrels per day in 2019 before falling by 7.4% in 2020. What we need to understand is the role of energy prices on the economic cycle. One analysis by John Kemp of Reuters at the end of October 2021 offers this. In the oil industry, the record of the last 4 decades implies prices will continue climbing, generating sufficient upward pressure on inflation until there is a slowdown in the global economy. Prices normally only stabilize when there is a recession or at least a mid-cycle slowdown in the United States and other major economies. I've noticed no reduction in the number of automobiles and trucks on the roadways because of the high cost of gasoline or diesel fuel. Reducing fuel consumption for many working people is difficult, dependent as we are on the automobile for transportation to work, for shopping and other daily activities. In many parts of the U.S., there is no other practical means of transportation. Arlington, Texas, with nearly 400,000 residents, does not even have bus service. 4 other cities with populations over 100,000 people have no public transit systems. While working from home saves money that would be spent on driving, the expenses for air conditioning in the summer and heating in the winter and general use of electricity are significant offsets. For families with young children, working at home can save the expense of childcare, but the lost income may be significant. We reached the end of the first part of this 8-part lecture series. The one important point I want you to keep in mind is that none of what we've discussed so far, none of the actions taken by government, none of the policies or changes in law have done anything to tame the economic cycle. These cycles repeat again and again and again. And the remainder of this series of lectures will hopefully explain why this is the case and what can be done to change that.